China's citric acid prices have increased roughly 5 times in recent months, multiple rounds of adjustments, in a relatively short period. For distributors and importers, this directly affects landed cost, margin planning, and purchasing decisions. So, what's driving this movement? Let's break it down from 4 angles: raw materials, export demand, currency impact, and seasonality. The primary raw material for citric acid production is corn, and corn prices in China have been trending upward. Domestic agricultural data shows firm pricing supported by supply-side tightening and demand recovery in feed sectors. Market sentiment also suggests corn prices may maintain upward pressure in the near term. When corn prices rise, production costs rise directly. At the same time, energy costs remain firm. Environmental compliance standards continue to increase. Periodic plant maintenance reduces short-term flexibility. Under China's energy efficiency framework, producers face a higher operational cost floor. When the cost floor rises, pricing flexibility becomes limited. This creates real structural support underneath current citric acid prices. On the demand side, China continues to be the world's largest citric acid production and export hub. Export activity across food and beverage, pharmaceutical, and industrial sectors has remained steady. When overseas demand stays consistent, supply allocation tightens. And when shipment momentum is healthy, producers gain stronger confidence in maintaining higher quotation levels. This isn't short-term speculation. It reflects real downstream consumption. Another factor is exchange rate movement. The Chinese RMB has strengthened compared to previous periods. When the RMB appreciates, export revenues convert into fewer. RMB producers experience margin compression. USD-denominated pricing becomes less favorable. To maintain operational margins, factories often need to adjust pricing accordingly. Currency alone doesn't drive the market, but combined with raw material inflation and export stability, it adds another layer of upward pressure. Seasonal demand also plays a role. The first half of the year typically sees stronger purchasing from beverage, food processing, and cleaning product manufacturers. In addition, ahead of major industry events like Food Ingredients China, procurement activity often becomes more concentrated. When buyers accelerate order confirmations within a short window, demand intensity increases. When multiple drivers align, cost pressure, export demand, and concentrated buying, the market naturally becomes firmer. So, what does this mean? Instead of trying to predict exact timing, it's more practical to focus on structure. Right now, raw material costs remain elevated. Export demand remains stable. Currency impact continues. Procurement cycles are active. When the cost foundation is strong, price momentum usually does not reverse quickly. In markets like this, replacement cost risk becomes an important factor for distributors. Securing supply when shipment channels remain structured and stable can help protect margin planning. The goal is not to chase price moves. It's to manage risk before cost structures shift again. From your perspective, have you seen multiple price adjustments from your suppliers recently? What signals are you observing in your local market? Share your market below. Let's compare global trends.